Let's start by understanding what happened. Pi network crashed to 12.8 cents. That's a significant low point. From that crash point, the token rebounded dramatically. It shot up to 19.8 cents. That's a 50% move in just a few days. 50% recoveries get attention. They look impressive. They signal buying pressure. But we need to understand the mechanics. The crash to 12.8 cents probably happened for a reason. Selling pressure, market downturn, whatever. The bounce suggests that selling was exhausted. Price got low enough that buyers saw value. Buyers stepped in. More buyers followed. Price accelerated upward. Now you have momentum. This is a normal bounce pattern. Nothing suspicious about it so far. Crashes create bounces. That's how markets work. But the critical question is this bounce the start of a sustained recovery, or is it a temporary bounce before another crash? That's where the technical levels matter. That's where resistance comes in. The 20-cent price point is significant for Pi Network. Traders are watching it intensely. Here's why. Resistance levels form because of previous price action. At some point in the past, Pi traded at 20 cents. Sellers showed up aggressively at that level. Price got rejected. It couldn't push higher. That established 20 cents as a resistance point. Now, when price approaches that level again, the same psychology repeats. Traders remember the previous rejection. They anticipate sellers will show up again. They're cautious about buying into resistance. They're watching to see if buyers will overcome the selling that previously existed. If price breaks above 20 cents decisively, it sends a signal. Buyers are stronger this time. The resistance is broken. Price could accelerate higher. Traders who believe in the breakout jump in. Momentum accelerates. Price keeps rising to the next resistance level. If price rejects at 20 cents and drops back, it sends a different signal. The resistance is holding. Sellers are still there. The bounce was temporary. Price will likely test lower levels. Traders exit positions. Momentum fades. So, 20 cents is binary. Either it breaks or it rejects. The breakout determines whether momentum continues or stalls. Now here's where the situation becomes problematic. Trading volume. Pi Network is currently recording approximately 25 million in daily trading volume. That's the total amount of Pi being bought and sold in a 24-hour period globally. For context, Bitcoin's daily volume is in the billions. Ethereum's daily volume is in the billions. Even mid-tier cryptocurrencies have daily volumes in the hundreds of millions. Pi's 25 million daily volume is microscopic. It's tiny. It's almost nothing. What does low volume mean for price action? It means there's not much buying or selling happening. It means price moves can be exaggerated because there's not enough supply or demand to absorb large trades smoothly. It means one large seller can crater the price. One large buyer can pump it. This is the fragility of the current bounce. The 50% recovery from 12.8 cents to 19.8 cents happened in low volume. That means it didn't take a lot of buying pressure to create that move. But it also means it won't take a lot of selling pressure to reverse it. If a large holder decides to exit and sells 1 million Pi tokens at market price, that could be significant selling pressure in a low volume environment. Price could crash. The bounce could reverse. The recovery could be completely undone. This is why traders watching this price action should be extremely cautious. The move looks impressive. The recovery looks real. But the liquidity situation makes it fragile. Volume needs to increase for this recovery to be sustainable. Today, we're diving into a risk that every trader should know about, the dead cat bounce. It's a scenario that catches even experienced investors off guard, and honestly, it's more common than most people realize. So, let's break down what it really means, and why you should pay close attention when it shows up in the markets. There's a technical pattern called a dead cat bounce. The name comes from the old trader saying, a dead cat will bounce if you drop it from high enough. It's morbid, but the point is real. Even dead assets bounce from crashes. A dead cat bounce looks exactly like what we're seeing with Pi. Crash to a low, about 12.8 cents, sudden reversal, bounce that looks impressive, up to 19.8 cents, and it really looks like recovery is real. But honestly, the bounce is temporary. It's just air coming out of the falling object. Soon the crash resumes. Price falls again. The recovery was illusion. How do you distinguish between a real recovery and a dead cat bounce? Volume is the key. Real recoveries have increasing volume. More buyers show up. They're convinced by the bounce. Volume expands. Price strength is confirmed. Dead cat bounces have light or decreasing volume. The bounce happens on low participation. Weak hands bought the dip. They didn't have conviction. Volume doesn't expand. Without volume confirmation, the bounce fails. Pi Network's bounce happened with volume recovery. According to the data, that's positive. That suggests some real buying conviction. But 25 million daily volume is still extremely low. It's not enough to confirm this bounce is real. The volume increase is real, relative to previous levels, but absolute volume is still insufficient for sustainable recovery. This is why traders should treat this rebound with caution. It could be the start of real recovery, or it could be a dead cat bounce that looks good temporarily before collapsing. The next few trading sessions will reveal which pattern is actually playing out. If you understand the difference between real recoveries and dead cat bounces, you need to like this video right now. One click helps the algorithm reach traders who think beyond surface-level price moves. Plus, share this with other traders watching Pi. They need to understand the difference between impressive-looking bounces and actually sustainable recovery. So, let's talk about volatility and liquidity for a moment. In crypto, these two factors can totally shape your trading experience. When liquidity is low, even small trades can cause the price to jump or drop pretty dramatically. That means, volatility goes up. On the flip side, when there's a lot of liquidity, price changes happen more smoothly, and big trades don't move the market as much. Understanding this relationship is key, especially if you're trading assets like Pi, where liquidity might not be as deep as Bitcoin or Ethereum. Just remember, the less liquid the market, the more unpredictable those price swings can be. Low liquidity creates high volatility potential. This is important to understand because it determines the risk profile of trading Pi at this level. In high liquidity markets like Bitcoin or Ethereum, price moves are smooth. Large buys don't spike price dramatically. Large sells don't crash it dramatically. The market absorbs the trades without extreme moves. In low liquidity markets like Pi, every trade moves price meaningfully. If a large buyer comes in, price shoots up. If a large seller comes in, price crashes down. The market can't absorb the trade smoothly. There's just not enough depth on the order book. This means traders holding Pi through the 20-cent test should expect volatility. Price might spike to 22 cents on a big buy order, then crash to 19 cents on a big sell order, all within the same day. All without any fundamental change, just low liquidity creating exaggerated swings. Swing traders can potentially profit from this volatility if they're watching closely and exit before crashes, but position traders holding for days or weeks are exposing themselves to significant drawdown potential. One bad day with a volume spike could erase days of gains. This is why the liquidity situation is so critical. It determines risk. Low liquidity equals high volatility, which means high risk. Traders need to position size accordingly. Smaller positions are required when volatility is elevated. So, let's talk about the technical setup and how all this comes together as we close out. Understanding the interplay between liquidity, volatility, and key price levels is really what separates successful traders from the rest. Staying alert to sudden volume spikes, watching for confirmation on breakouts or breakdowns, and sizing positions to match the risk, these are all crucial steps. As we wrap up, remember, technical setups are only as reliable as the liquidity and volume behind them. Keep your approach disciplined, and always be ready to adapt as new information comes in. So, here's what traders are actually watching. Will Pi break above 20 cents decisively? If yes, next resistance levels would be in the 22 to 25 cent range. Price could continue recovering, momentum could build, recovery could prove real. If Pi rejects at 20 cents and rolls over, the bounce fails. Price would likely test lower, could drop back toward 15 cents, could even retest the 12.8 cent lows. The recovery would be proven to be a bounce, not a reversal. Volume expansion is crucial. If breakout above 20 cents happens on a volume surge, that's bullish confirmation. If rejection at 20 cents happens on high volume, that's bearish confirmation. The worst case scenario is price action happening on extremely thin volume. That creates uncertainty. Moves are questioned. Real support or resistance is unclear. This is where Pi currently sits. The recovery happened. The technical setup is positioned, but volume is too low to provide certainty about what comes next. Thank you for watching this technical analysis. Pi Network's 50% bounce from 12.8 cents to 19.8 cents looks impressive. The 20-cent resistance is the critical level, but the liquidity situation, 25 million daily volume, makes this move fragile and volatile. Real recovery requires volume expansion and a decisive break above 20 cents. Dead cat bounce patterns end with rejection and price collapse. Understanding which scenario is actually playing out requires watching volume and price action carefully over the next trading sessions. If you want to stay updated on Pi's price action as it tests 20 cents, whether it breaks or rejects, how volume confirms or denies the move, what the next resistance levels are, stay subscribed. We're tracking when technical setup meets actual execution. Check out the other videos on TJ Crypto World. We've got deep dives on resistance levels, volume analysis, dead cat bounce patterns, and everything else you need to trade technical setups effectively. I appreciate you watching. I appreciate the trading community, and I'll see you in the next technical analysis.